I saw in some of your comments that you were like, can you do a video about stocks? Can you explain the stock market? And so I will do my best. Today's video is going to be skewed towards personal finance, which is tied to your financial freedom, which I believe is one of the things that we have to take charge of. And if you don't know me, my name is Mandy. I am a career coach and a writer, and I talk about how to bring more creativity and joy into your life. So if you are new to personal finance, if you are, for example, more of a creative person who has been like, I don't really understand numbers, okay? I was totally there too. So I'm going to be using examples that like my brain can understand and hopefully it like makes sense to you as well. Okay. So before you can understand like what a stock is and how it works, okay, we're going to break it down and talk about how companies in general work. I want you to imagine that, let's say you decided to start a cupcake business. Okay, so it starts first out of your home. You're like, I'm just gonna be a little side hustle. I'm gonna go get the ingredients. I'm gonna make red velvet cupcakes. This is gonna be like my thing. Okay, so you start a little company and you're making cupcakes, and let's say it's like going pretty well. You make like $200 a week, and then you're like, holy crap, if I'm making $200 a week, then every month I'm making like $800. Like, this is actually real money. Okay. So you do that for a year and everything's like going great. Okay. Then you decide, you know what? Like, this is so crazy. I never thought I'd do this, but I actually want to go get like a tiny like retail space on the outskirts of town, and I want to just like open up my first store. Okay. So what do? You have money saved. You maybe ask your parents, if they can, they give you, let's say $5,000. You then go to the bank and you're like, hey, here are all my receipts. Like, and you bring them a cupcake and you're like, my cupcakes are amazing. Like, I'm looking for a loan so that I can open up a store. Okay. On a really basic level, this is how most businesses are going to start. It's going to be like, there is a product that you are creating. People like it, you're good at it, and then you grow that business over time. Okay. Now imagine your cupcakes are so amazing and you had a cupcake go viral. So now not only do you have the cupcake store, but you now also have like direct to consumer. You're like selling on your website. Okay. And let's say that you're bringing in like $10,000 or $20,000 a month. Okay, this is like you've quit your full-time job at this point. You were all in on this cupcake business. And now not only do you have red velvet, but you also really specialize in carrot cake cupcakes and a blueberry or raspberry cupcake, depending on what's in season. Okay, so this is your life. And imagine that as you have grown the company, now you have 10 employees. You have people who like work in the bakery, but then you also have people that are like, one girl does like marketing for you, another person does finance for you. Your husband has quit his job or your partner has quit their job, and now like they're your CFO or they're your COO and you're the CEO of this company. Okay. Now in the beginning, for these sort of senior level hires, you might tell them, you know what, like, I know we're just a 10-person shop right now, but people are obsessed with these cupcakes and it keeps growing. So in addition to the salary that I'm going to give you, I'm going to give you a piece of the company. I'm actually going to give you equity. I'm going to give you sweat equity. Okay, so sweat equity is basically when you get a percentage of the company in exchange for all of your hard work and kind of like believing in this before it was a thing. Okay. So let's break down the equity piece. So let's say that you, in the beginning, of course, you own 100% of this cupcake company. Duh, you are the one who like put up all the capital. You're the one who took the risk. Like, it's yours. It's your company. Okay. But then as you grew, you were like, you know what? I'm gonna reserve 10% of this company, even though it's just on paper. I'm gonna reserve 10% of the company for my first key hires, like the first people who really help me build and scale this company. I'm going to reserve some percentage of the company for them. Okay. So you're still in kind of like the mom and pop stage. You own 90% of the company. You have 10% of the company that you can at any point be like, oh my gosh, head of marketing, I am so obsessed with you. You have been going above and beyond. So I'm going to give you some percentage shares of the company. Okay. So actually, I'm going to give you 2% of the company. And of course, like the way this is structured is nobody just gets 2%. It's usually on like a vesting schedule, meaning like if you stay for at least a year, then you get the first 25% of your shares. And then every month after, you get like a little bit more. This kind of just guarantees that people who are getting those shares or getting that equity are people who've like put in their time. So are you still with me? Okay. So now imagine you have 2 stores. You have your online business, which is thriving. It's still a 10-person business, but you're now a major player. Like people say your name of cupcakes and people are like, oh, I've heard of that. You know what I'm saying? And you can see the future. You could be like, you know what? I think this company could really grow. Like, no, you know, we're only in our state right now, but like what's to say, like, you know, I grew up in Michigan, and what's to say that I couldn't open up a store there? Like, I'm sure it would be successful, right? So at this point in your company's growth, you may then be like, I think I'm actually ready for some outside investors. Okay, you hear this, right? You hear people who are small business owners who are then like, I want to find an investor. The idea here is that they're basically going to give you cash so that you can exponentially grow the company. So oftentimes in this sort of like growth area of companies, they would say like the first year or 2 is figuring out what works. Like, okay, I know my systems, I know my operations, I know my flavors, I know what people want, I know what markets to open up in. And then when you get investors, they're going to give you cash. So you can basically pour fuel on it and then exponentially explode your business. That is the idea, right? Of course, investors are not doing this out of the goodness of their heart. And when I say investor, this is like if you ever hear like, oh, that person works in venture capital. Venture capital is essentially a group of people that go around and get investment from big companies, other organizations, philanthropists, rich people, right? They pool that money and then they have what's called a fund. So sometimes you might hear like, oh, they have X 100 million under management, or they have X billion under management. It means that that's how much money other people have given them to be like, we trust your ability to like scout and find the best companies or the best investments that are out there. And we trust that you're going to make smart seed investments, right? Planting the seeds in many different small companies, or as companies grow in stages, you know, Series A investment, Series B investment. So a venture capital fund, like their whole point is for them to go around and find promising companies that they can invest in. Like I said, though, they're not doing this out of the goodness of their heart. Of course not. They're doing this because they want a return. Have you ever heard the term return on investment? Okay. Investors, they are looking for an exit. They're saying, okay, I see you, little cupcake company, and I think if I put in $1 million today, that based on your track record, based on the fact that people are obsessed with cupcakes, based on the fact that we kind of like you and we like what you're doing. Okay, this is what like Shark Tank, the TV show, simulates basically, right? Sure, we'll give you $1 million. But in return, what I'm expecting is I not only expect to get my money back, but I expect to make money off of that initial investment. Okay, so I have to pause here and also explain the different stages that a company is going to go through. Okay, so again, when you're just a baby company and you're doing like, you're taking a loan from your parents, or you're asking like a rich uncle to, I don't have a rich uncle, but imagine, you're asking for people that you know to invest in your company. That's going to be the very, very first baby stage. That's going to be called friends and family. Okay. Then as you move into more institutional investors, meaning now you're taking money from like people who are like, do this for a living and aren't just giving it to you because it's like a Kickstarter and they just want to support you. It's like, no, they've like done the math and they've been like, well, we think your business is actually sound, right? That is going to be called seed stage. Okay. As a company moves through its growth, it's going to hit different milestones. Okay, so you're going to hear Series A. Oh, the Series A is essentially the first big check that a company gets written from these outside investors. Then they move on to Series B, then Series C, D, E, F, G. Okay? Series G is like, holy shit. At Series G, I mean, that's when companies are raising hundreds of millions of dollars, right? And the reason that there are these milestones is because imagine that you are an investor. You don't like do cupcakes for a living. You just like this girl who's doing cupcakes. So what you're probably going to do is you're probably going to invest in multiple cupcake companies. And you're going to be like, yeah, I'm going to give them each at first maybe a couple $100,000 and we'll see how it goes. Right? Because nothing works in the market like actual experience. Like you can talk all you want, but at the end of the day, it's about results, right? And that's why venture capital, that's why they're going to seed a bunch of companies, just like you would plant a bunch of seeds at the beginning of the season. And then you know how you never know? You're like, I don't know if this tomato is going to take off, or I don't know if this zucchini is going to take off. But that's why you plant a bunch of seeds and you see what actually grows. Okay, the venture capital firms are doing essentially the same thing. And so there are certain checkpoints, right? Let's say I've invested in 2 cupcake companies. I like them both equally. Let's see, may the best man or woman win. Right? So these 2 companies are out and about, and maybe one of them is like absolutely crushing it and the other is struggling because actually that leader kind of sucks, right? And so in order to kind of release that next level of funding, there are certain milestones that your company has to hit, right? So you're not going to get a Series B funding unless your Series A went well. And often this is a conversation that the founders and the investors are going to have where it's like, oh yeah, we do want you to hit a Series B, but in order to do that, we want to see $100,000 a month in revenue. We want to see a certain level of profitability. We want to see a certain low acquisition cost for when you're going out and getting new customers, right? There's things that they're not going to just like give you their money. They're going to do it based on whether you hit these certain checkpoints. Okay. I'm saying all of this to say that the way that businesses are structured are all about the exit, okay? So people are putting their money in because they believe at some point they're going to get their money out. And so from the company's perspective, there are a few ways that they can actually deliver the return to their investors and of course to themselves, right? One of these ways, for example, is an acquisition. So let's say you're like crushing it. You now have 5 stores. You've taken on a little bit of external money, but you're just like doing really well. And then Big Cupcake comes in. I'm talking like a General Mills, or I'm talking like a Dannon, or one of these like big food companies sees you, is like, I want what they have because we actually want to get into cupcakes and we want to bring cupcakes to like every supermarket in America, right? They're going to make you an offer. They're going to say, you know what? We're going to pay you $50 million for your cupcake company. Okay. So that would be a great day for the founders of the company, for the investors of the company, because everybody at that point has shares in the company. So let's say at that point, I owned 50% of the company and someone makes me an offer for $100 million. Guess what? I get to take home $50 million. Okay. That is what's called an exit or a liquidity event. Not everyone is going to get acquired though, right? Some companies are going to say, I don't want to be acquired. I actually have my sights set bigger. I want to go public. So the difference between a private company and a public company, right? A private company means the ownership of the company is owned by, me, my initial employees, probably my partner has a little bit. My investors have a huge chunk of it because they've pumped money into the company. So in exchange, I've given them 20% or 30% of the company. And so that is a privately held company, meaning all the shares that we hold are private. Like, you can't go online and buy a share of my cupcake company because it's privately owned. Okay? The difference is publicly owned companies means that anybody and their mother can go and purchase shares of that company. So something that companies really want to go towards would be an IPO. So initial public offering. Okay, so you've heard like when these tech companies, they're all like, oh, we want to IPO. We want to go on the public market. What they're really looking for is to turn their privately held shares that they can't do anything with because it's like a closed, like I own shares and my friend and first employee own shares. That's it, right? To a situation where it is open to the public. And now my shares are actually buyable. I can do something with them. If I own 100,000 shares, I now know I can look at the stock price and be like, I own 100,000 shares and it's trading at $10 a share. Holy crap, this can be real now. Now I can transfer this into real money. Okay, so when you buy a stock, what you're doing is you are buying a piece of that company. And all a stock market is telling you what that share is currently worth to the minute. And so if you were the original founder of the cupcake company, right? If you had an IPO, this is like a beautiful day for you because all the shares that you own in the company, you can now, you've heard the term cash out, right? You could now trade it in. You could be like, oh my God, I own 1 million shares of this company. And now I can trade it in for real hard cash. Like, that's amazing. And that's also why, like, in the big tech boom, for example, you would hear like, oh, all these people overnight became millionaires because they had stock in the company, but it happened to be like a super successful company with a great IPO. And now their paper shares that they just had, as digital, like nothing, just like paper, they can go onto the stock market and they can actually change that for money. Like, that's crazy, right? So you might think like, well, how do we determine how many shares there are? Well, I'll tell you, when I was running a startup back in New York City, we literally determined how many shares, like we just made it up. We were like, okay, let's start with 200,000. Like, does that sound good? So every company is going to have a different number of shares that exist. Okay, so I'll just tell you some examples. Microsoft, for example, has 7.4 billion shares that exist in the market. Pinterest, for example, has 678 million shares outstanding in the market. So it doesn't it's sort of arbitrary, to be honest with you. You don't have to worry about like how many shares are there outstanding. I'm just giving you some examples. All right, so when you are picking stocks, I want you to think about stocks as a brand. Okay, so what is a brand? A brand is essentially a promise. So when you think about Starbucks, what is the promise of Starbucks, right? You can imagine it. You walk in, there's sort of that light wood. You can obviously get coffee, you can get those cake pops, there's the green logo. Like, there's a certain experience and promise associated with Starbucks as a brand. Same thing, Disney is a brand. It is an entertainment company. It's an experience company. It's a cartoon company. It's a kids company, right? So you want to be thinking about How do I feel about this brand? Do I trust this brand? Do I feel like they're gonna be around for a while? What has been the historical performance of this brand? Okay, so I'm gonna use a very simple example to explain this. Okay, so this is a Michael Kors purse that I bought at an outlet in Colorado like 5 years ago. I had to go to a wedding. Okay, so I actually bought this purse on clearance. It's actually in really good shape, for, like the hardware hasn't faded. Like it's still kind of timeless, still kind of cute. I think I paid $50 for this Michael Kors purse. Now, why did I purchase it at an outlet? Because I love a bargain. I love a deal. I looked at its intrinsic value, right? Which is, I said, okay, this is leather. There's like a gold strap. There's some nice hardware. It's a cute size. Like I can wear it as a crossbody. I can adjust the strap, And I said to myself, this is a cute purse. And for the price, that's an awesome deal. I also knew, because I had walked across the street to the Coach outlet and to the Kate Spade outlet, right? I also knew that this was a good deal for a leather purse of this size. Other purses were going for $90, $100. I was like, for $50, like you can't beat this. So if you have that instinct, if you understand that this at $50 is a good deal, then you're going to have no problem with the stock market because it is literally the same. I'm going to walk you all through a very specific example so you could see exactly what I'm talking about. Okay, so we're going to be looking at this Marriott stock, Marriott hotels, The first thing that I always do with every stock is I look at its all-time historical, because I want to see from the moment that this stock IPO'd on the market, the moment that it was first available on the market to now, right? And that could go back 15, 20 years. Or if it's a more recent tech stock, it might be, 5 years, right? I like to look at all of it. I like to see what has been a historical high, what has been the trend recently, right? And again, just to bring this back to our little purse example, this would be just being able to, like, if you had a chart to see what was the price of this purse over time. Like when this purse was first launched, in 1990, let's say, then it was $20. And then I bought it at $50. But if you were to buy this today, the purse would cost $90. I don't know, because of more expensive materials or the brand value has gone up, whatever it is. So I look at that chart and I study the long curve, like what's been going on over the long term. And then I look at what's been happening, let's say, in the past year. So again, with a stock, you're going to see the price change every single day. And why is that? Okay, it comes down to supply and demand. So let me give you an example. So you know how right now, if you go to the supermarket, eggs are like crazy expensive, okay? Because here's the problem, all right? About a year ago, eggs were what I would say is like a normal price, $2.99, $3.25 for a dozen, okay? Then with the recent bird flu, now it'll be like limit 1 carton per family. Because of the bird flu, basically anytime a bird gets sick, they have to remove the entire flock, okay? So that means the number of chickens that are like there's just less chickens in the US to lay the eggs. But our American appetite for eggs has not decreased, right? So same amount of demand, lower number of chickens means the price goes up. Okay, so now I'm not even kidding. First off, when I went to Costco, they didn't even have eggs. And then now in my regular supermarket, which is like a Kroger supermarket, you cannot buy a dozen eggs for less than $5.99. Like I'm lucky if I find it for $5. You know what I'm saying? So it's the same idea. If there is a stock that's really, really in demand and people are buying it, right, the price goes up. And that's why the stock market is always changing. Back to my Marriott example. In May of 2020, I bought 4 shares of Marriott. Why? Because that was peak pandemic and nobody was traveling and nobody's going to a hotel. Okay, that's for sure. But I said to myself, well, one day this will be over. And so the price seems good now. Because again, I looked at the lifetime historical and I saw that Marriott was taking a dip because of the pandemic. And I said, now would be a good time to buy. So I bought 4 shares, nothing fancy. And for those 4 shares, I paid $87.57 per share. Granted, that was 5 years ago, but the stock price today, okay, and obviously this could change over time, but stock price today is $286. So this is the equivalent of me buying the purse for $50, and now on the open market, let's say the purse is going for $125. I could turn in this purse, somebody's gonna buy it, I'm gonna be like, great, I only spent $50, you're gonna pay me $125, let's go, we have a deal. So basically, I bought something at the time that was $87, and now it's $286. So it's like, in my brain, I'm like, that's like not hard. I paid $87, now it's worth almost 3 times that. Okay, great. I made money. That is how the stock market works. That's it. It's that simple. Now, it looks like 6 months ago, I went in and I bought 2 more shares. However, of course, the price isn't 86 anymore. 6 months ago, the price was $231. That's still $50 less than what it is today. So I'm still making money. Okay, the last thing that I want to explain, because I think there could be like a lot more deep dives, and I'm such a nerd and I'm into this, and I hope you are too. But what I want to explain is the idea of like an index fund. And that is essentially the idea where you, instead of going through and picking like, I want to invest in Marriott, I want to invest in Apple, like it basically does a conglomerate. Now, this is a great way to start investing. This is actually how I started investing, because I was a little bit intimidated to be like, to put all my chips in one thing. I was like, I don't know. Like, I don't know how to choose. So in the beginning, I kind of did 50-50, where 50% of my investments were index funds and the other 50% were just like individual stocks that I felt like pretty confident that, okay, these are not gonna really go wrong. They were things like Disney, Marriott, Apple, Google, etc. Okay, so there's something called the S&P 500. Okay, the S&P 500 is essentially a way to track the top 500 largest stocks in the US. Now, if you look at the 500 top stocks in the US, okay, you want to look at the average return. So I'll throw up a chart, but essentially 2023, for example, the average return was almost 27%. And then 2024, the average return was 25%. So inside of the S&P 500, again, it's the 500 largest stocks, right? So you have Apple, Microsoft, Nvidia, Amazon, Meta, Alphabet, Berkshire Hathaway, which is owned by Warren Buffett, Broadcom, Tesla. Okay, so you have these huge companies that are sort of like driving the S&P 500. Now, if you wanted to, there's actually an index fund called basically S&P 500. You could just buy a share of that. So you wouldn't even have to pick anything. You could just pick, I want to invest in the stock market essentially as a whole. You can also look at index funds that are run by specific companies. Like, for example, Vanguard has one called VGT. That's one that I've been investing in a lot. And that is a conglomeration of all of the biggest technology stocks. So you can invest by sector. Now, as a comparison, okay, because let's say you have money that you want to invest. And again, this does not have to be a lot of money, but as a comparison, right now in my high yield savings account, the return on that is 3.9%. I would encourage you to just look at this chart, because there are, and it's about every 10 years, okay, there are going to be years where there is negative return. Okay, so the 2008 financial crisis, you've got the 2000 bubble I can see on here, and then you've also got around the pandemic 2022 negative 18%, right? So you have these moments where basically everybody's gonna freak out. It's cyclical. It's totally cyclical. But one of my philosophies is that I'm buying and I'm holding. So I'm going to end this with a little story. So back in the beginning of my investing journey, I remember I was on a call with a client. This was back when I was like still had a full-time job. And she was like, "Oh my gosh," this was like peak pandemic. And she was like, "Oh my gosh, the stock market, all my stocks are like falling precipitously. Oh, I think I have to like sell them all. I think I have to sell them all." And here's what, if you've studied anything about long-term investing, which is basically Warren Buffett's strategy of investing, right? He basically says like, no, you have to be strong and hold. And in times when the stock market is falling, again, you can look at the historical performance, know that about every 10 years or so, sometimes more, there will be these moments where there are these huge drops in the market. Unforeseen events, financial collapse, worldwide global pandemic, like these things happen, right? But it's in those times that you have to be strong. And that so I was on the call with her and I like didn't have time to explain like, yeah, but long-term investing and this is a cyclical part of the market and everybody understands this. I just was like, okay, so common person is freaking out about their stocks. That's going to be herd. That's going to be the herd mentality. This is now a time for me to buy. That is when I went in and I bought stock. When everybody was selling theirs, that's when I bought. That's when I got the Marriott stock on sale, right? That's when everybody's running to return their bags. That's when I walked into the store and I was like, "I'd like a discount on this, please. Thank you." Right? So that's just one of the strategies. I know there's so much more I could talk about. I hope this was helpful. And my whole goal here is to just educate and share what I know, which is not everything. I'm definitely still like a bit of a dum-dum. I'm definitely still a newbie, but there is stuff I know and I'm determined to at least share my journey so far. So thank you guys for watching. I love you and I will see you soon. Okay, bye.